In this video, let's work exercise 18.25 out of chapter 18. And as the problem indicates, we're going to study the NOL carry forward and consider any valuation account needed. So as always, let's take a look at the problem and then work our way through the instructions. So it says Meyer reported the following pre-tax financial income or losses for the years 2025, 2026, and 2027. And we see in 2025 that we had a $120,000 income, 2026, a $150,000 loss, and then in 2027, we returned to income of $190,000. Pre-tax financial income or loss and taxable income and loss were the same for all years involved. And the enacted tax rate was 20% for the 3 years, 25, 26, 27. So the first thing, step A, prepare the journal entries for the tax years, for the years 2025, 26, 27 to record income tax expense, income tax payable, and the tax effects of the loss carry forward. Assuming that that based on the weight of available evidence, it is more likely than not that 1/5 of the benefits of the loss carry forward will not be realized. And then part B, prepare the income tax section of the 2026 income tax statement, beginning with the line, quote, income or loss before income taxes. All right, so let's work through our instructions here, given the facts that were presented in the problem. Okay, so in part A, we want to prepare the journal entries that are going to record the tax expense, income tax payable, and tax effects of any loss carried forward for the 3 years. So we'll end up having 3 journal entries, one for 2025, a series of journal entries for 2026, and then some journal entries for 2027. Okay, so let's start. So if we look back into 2025, we did have taxable income. It says pre-tax financial income was $120,000. And then the paragraph below the table says that pre-tax financial income or loss and taxable income are the same. All right, so for 2025, let's see, pre-tax financial income and taxable income equaled to $120,000. Okay, so let's prepare our journal entry for A for 2025. So this would be 12/31/2025. Let me stretch these out a little bit. And we'll have a debit to income tax expense. And then a credit to income taxes payable. And the respective amounts for this, we had a $120,000 taxable income. And the problem said that our enacted tax rate is 20% for all years involved. Multiply that by 20%, and we get $24,000. So we'll have a debit to the income tax expense of $24,000 and a credit to income tax payable, $24,000. All right, so that's the 2025 entry. Now let's move down to 2026. And here we have a loss this year. So for this year, we had a loss, as it says in the table, for 2026 of $150,000. So what this is going to do, this is going to create a deferred tax asset. We do not have to pay taxes. So the entry we made in 2025, we will not be making for 2026. Since we have a taxable loss of $150,000. So as we know, a loss results in a deferred tax asset, meaning we may be able to save taxes in the future by the benefit of the carry forward. So let's record it to our deferred tax asset. And there'll be a credit to income tax expense benefit. And this is related to the carry forward. Our dollar amounts involved, we have a $150,000 loss, and our enacted tax rate is 20%. So that's going to equal $30,000, and then the credit to income tax expense / benefit for the carry forward is also $30,000. But if we keep on reading into part A, it does say that assuming the second part, assuming that based on the weight of the available evidence, it is more likely than not that 1/5 of the benefits of the carry loss forward will not be realized. So if 1/5 of our carry forward, which is $30,000, the deferred tax asset, is not going to be realized, that means 4/5 will be realized, or we anticipate that it will be realized, but 1/5 of the benefits of the lost carry forward will not be realized, then we need to create a valuation allowance for that. So also at December 31st, 2026, we will debit the income tax expense benefit account again, and we will credit an allowance. And it's a long account name, but basically it's your valuation allowance. So we debit the income tax expense slash benefit, the same account for as above that we used, and then we'll credit the allowance that reduces the deferred tax asset to net realizable value. So how much is this dollar amount going to be? Well, we have a benefit here, a deferred tax asset of 30,000. And as the problem says, 1/5, that's 20%, or 1 divided by 5, 1/5 of the deferred tax asset carry forward will not be realized. And so that equals $6,000. And so I will then credit the valuation allowance to reduce the deferred tax asset to their expected realizable value. So the net impact for 2026 is $24,000 in assets. We have a deferred tax asset of 30,000 with a valuation allowance of 6,000. So the impact to assets is 24,000. And then the impact to the income statement is also 24,000. We have a credit of 3,000 offsetting by a $6,000 debit is a net credit of 24,000. So the net income tax expense slash benefit is 24,000 that's shown on the income statement for 2026. And the impact to total assets is also 24,000 net. Next, let's turn and work on 2027. So 2027, it's $190,000 income. However, we have a carry forward. So let's do a quick calculation here. So we had a carry forward of $150,000 tax loss. So let's see, taxable income for 2027, and that was given to us in the problem at $190,000. And then we can offset our carry forward from 2026, and that was $150,000. And so the net impact, we net those together, we get that it's $40,000. Let me add some formatting here for us. Okay. So that's going to be the next net taxable income for 2027. So what that tells us, that's the amount of my payable, not that amount, time, of course, times the tax rate of 20%. So my taxable income is 40,000. I know I'm going to owe the IRS 20% tax rate of that, which is $8,000. So let's set up the journal entry. We'll have an expense this year since we've had such a large income, and it offset completely the carry forward from 2026. Let's find these amounts for this journal entry. All right, so our income tax payable is going to be our taxable income times our tax rate. So our taxable income, as we calculated a second ago, was $40,000, and our tax rate is 20%. So that gives us $8,000. And then we can offset our taxable income by the carry forward, which in the prior year was a deferred tax asset. So that deferred tax asset, let's go ahead and use all of that. Why not? Of $30,000. So we will offset completely, and that's where this, obviously, this multiply this by 20%, this by 20%, and we can see where these amounts are coming from. And so that does agree with what we had in the previous year for a deferred tax asset. So if we net those together, we get our income tax expense of $38,000. And you can see how that matches right there. So if we take our gross totals, multiply them by our tax rate of 20%, we get these numbers over here. And so we transform those into a journal entry. So our income tax expense is $38,000, and we are allowed to carry forward $150,000 of loss from 2026, which is times 0.2%, try that again, times 20% is a reduction of $30,000. So the only amount we actually owe is $8,000. Now, what we also have to do is we have to consider that there was that allowance that reduced the deferred tax asset. We're also using that this year. So that journal entry from the previous year, we did use the entire carry forward, so that valuation allowance also needs to be reconciled to zero. So debit the allowance to reduce deferred tax assets to expected realizable value. Debit that. That will make that go to zero. And then we will credit income tax expense benefit. Since we reserved with a valuation allowance $6,000 in the previous year, 2026, we were conservative in assuming that 1/5 of the benefits of a carry forward would not be realized. However, that was not true. We ended up using 100% of the benefits of the loss carry forward. And so because we had that valuation allowance, we were able to reverse it. And so this is essentially a reverse of the journal entry that we recorded in 2026. Okay, that concludes the requirements for Part A. Let's now turn to Part B. So Part B asks us to prepare the income tax section of the 2026 income statement, beginning with the line income or loss before income taxes. Okay. Income, loss before income taxes. Okay, this amount was given to us in the problem, and we're doing 2026 here. And that was a loss of $150,000. And then we will record the income taxes. Let's see, we had a benefit that year. So we'll count the income tax benefit. So let's go back to 2026 and see. So we had a credit of 30,000 offset by a debit of 6,000. So the net impact to income tax expense / benefit was $24,000 on the credit side, which would be a benefit. So that's going to actually reduce our loss position. So our final line, which will be net income or loss, is the sum of those two numbers, which is $126,000. So just to double check, make sure we look at this line. The income tax benefit is a function of the carry forward deferred tax asset, which is $30,000 on line 8, offset by the allowance we reserved, which was $6,000. Well, I said line 8. The $30,000 between line 8 and 9, offset by the $6,000 on line 11, left us with an income tax benefit of $24,000 and a net loss position for 2026 of $126,000. So at this point, this does conclude solving exercise 1825 out of chapter 18.